Good morning, traders and investors. My name is 𝗧𝗴𝗀, and I'm the Senior Strategist for 𝗧𝗴𝗀. Today is May 27th. It's a Thursday, and it's the last Thursday of the last week of the trading week of May before the holiday weekend begins. Now, it's also my dad's birthday, so it's a great day. I'm going to take him out to dinner tonight. Celebrate. My dad is a great guy. Very, very cool guy. All right, so bond market. All eyes are on the bond market. Notice we're at this resistance level right here, or getting really close to this resistance level right here, which means there's a chance the bond market will go higher. Now, I explained this yesterday, and I spent about 17 minutes on this yesterday, so I'm not going to go through it today. But we have GDP coming out today and durable goods, but honestly, the big report is going to be GDP. Jobless claims has been really good. Durable goods is not as big of a report. The biggest report of the quarter is today. It is the GDP, and it's going to let us know if the economy is running too hot. Now, if the number is above 6.5 or 6.5, I'm expecting the bond market. Let me go to the bond market. I'm expecting the bond market to rally, to break above this level and possibly go a little higher. Why? Because if the economy is running really, really hot, then the Fed may take away some of the stimulus. If the economy is running really cool, then they're not going to take away any stimulus. So if this number, if the number shows that the economy is not sizzling hot, if it's not 6.5, 7%, that means we're not running that hot. And if we're not running that hot, right, that means the Fed will probably not take any action. But if we're finding out that we're running too hot, then or that we need to cool off a little bit, some of the stimulus may come back, and that would be weaker for the interest rate market. That would deflate rates, and that would cause bonds to go lower. So again, it all depends on today's report. If the economy is too hot, right, then the Fed may take away some of the stimulus, and bond and interest rates will deflate. If the economy is running a little bit too cool, then they're not going to take any action. So a lot of it depends on what they're going to do. And remember, there's an inverse correlation between the bond market and interest rates. So if bonds go higher, interest rates go lower. If interest rates go lower, bonds go higher. And in this case, I think interest rates are going to go slightly lower. I don't think they're going to be going up too much right now. I think the Fed is going to decide or find out based on today's report that the economy is running okay, and there's really no need to do anything at this point. We are seeing inflation, but I think that's reasonable in light of what we're seeing right now. But again, if you see a breakout in the bond market, that means interest rates are going lower, not higher. And if interest rates are going lower and not higher, that means the Fed is just not going to take any action, and they're just going to kind of cool off a little bit. So let's keep an eye on the GDP. That's coming out at 8:30. It's about 8 o'clock. It's coming out in about half an hour. In terms of the overall market right now, and again, today's market is going to be driven by the bond market and financials. Everything else is going to be secondary because that's what the GDP reflects upon. Nasdaq is down a little bit, not a lot. The Dow futures is holding steady. Russell's a little down. Really can't really make much of this. Mostly random action right now. If you look at the S&P though, on a whole, it looks like it's now completely above the 50-day moving average. Bounced really well. The QQQ is now going to be, I believe, third day above right here. Yeah, it has 2 days of clearance, so we're now officially bullish. Hopefully we won't come back down, and this won't become a downtrend, because the Nasdaq, it has the most sensitivity to rates going higher. If the rates go higher, it's going to put a damper on the Nasdaq. So if you see bonds go lower, that means interest rates are going higher, and that means there's a wet blanket on the Nasdaq. I wanted to kind of give you a little bit of an understanding of how it works. If the economy's cooling off, it's a little counterintuitive because the Fed is purposely trying to heat up the economy right now. So you're going to have to keep your eye on the bond market, and this is the TLT, and it's opening a little lower. But if it breaks above the 140.60 level, 141 level, there's a good chance we can go up to about the 144 level before coming down once again. I don't think that's going to happen. I think we're going to continue staying within this range. But again, with the with the GDP coming out, it's really hard to determine if the economy is going to run hot or cold in relationship to how it's been doing. Now, as far as stocks right now, I am liking the mid caps right now. Because the mid caps have a good balance between financial stocks and blue chip stocks. And as you could see here, the mid cap has been flattening out a little bit, moving towards the 50-day moving average. And I believe it's going to kind of hover here or maybe come up. But what I like about it right now is that it gives us a low risk entry. And there's a few stocks that I like. So I'll start with this one, 𝗧𝗴𝘀, 𝗧𝗴𝗀𝗧 Energy. It's hitting the 50-day moving average, and it has a really good relative strength score on my stock fetcher code. So it's pulling back to the 50-day moving average. The RSI is hooking back up around after hitting 40. Not 30, but this didn't go down into the twilight zone, and it's a pullback from the first high, and it's touching the 50-day line. So I do like 𝗧𝗡𝐶 right now. And what does 𝗧𝗡𝐶 do? It is a crude oil, petroleum, natural gas exploration, and it's in the Russell 400. 145% return. Not bad, right? Next stock, Synnex Corporation. Pulled back and now is making highs, but I like this flat breakout. And if you look at what they do, you will see that they are also in the index, in the Russell 2000, and this is in the S&P 400, mid-cap, sorry. 193% over the last year. What do they do? Business to business, help customers and business grow and enhance their customer engagement strategy. Peripheral equipment, business, IT equipment, with more than 100,000 associates, 25 countries, IT distribution. It looks like IT, remember, things are starting to heat up. Employers are asking employees to come back to work. So we may see more upside, and I like this flat breakout. I love the, let me just do this here. I like the ascending triangles because the ascending triangles are still within range. They haven't broken out yet, and it looks like the stock can really break out. I like this stock, Synnex, SNX ticker symbol. So the first one was 𝗧𝗴𝗀𝗧, and this one is SNX. Next one is Champion X Corporation. Again, it's a Russell 2000 and a S&P 400. 1 year return, almost 200%. What do they do? Mining, material handling, construction, solutions for companies drill for and produce oil and gas. Talk about being in the right place at the right time. And as far as the chart, also like this ascending triangle here that we're seeing. And it hasn't really broken out yet. So I kind of like that. I like the fact that it's in its little cocoon, so to speak. Let's see that. There you go. Could have a potential to break out quite nicely. And last but not least, I mentioned this stock a few days ago, might have been even yesterday. Illinois Toolworks. It is a S&P 500 stock. It's an industrial stock, 32% return. It is the world's leading diversified manufacturer of specialized industrial tools, consumables, related services. You couldn't be in a better place. Machinery, equipment, industrial, boring stocks. And look what it's doing. It's pulling to the 50-day moving average. So we got ITW, we got CHX, we got SNX, and we got 𝗧𝗡𝐶. That's 𝗧𝗡𝐶, SNX, Champion X, and Illinois Toolworks. Again, mid-cap, mid-cap, mid-cap. The only one that's not in the mid-cap, I think, is this one right here, Illinois Toolworks. The rest of these are in the mid-cap. Now, folks, I got something important, timely, really crucial for you. We're probably all aware of what Wall Street legend Chuck Hughes has been doing lately. Of course we are. How could you not? So the enormous gains he's pulled from the stock market and the way he's been helping traders around the globe reach their dreams, they're not exactly a well-kept secret at this time. Not anymore, at least. Now, Chuck is also giving everyday traders a chance to completely transform their lives over this summer. And it all starts June 1st. He's starting trades off with a special $50,000 challenge account. And he's equipping them with all of the tools and accoutrements necessary to back the returns of a lifetime. $50,000 account. It's a special account, a simulated account that'll let you execute trades and follow along with Chuck so you could really see what he's doing in real time and help you become a championship level trader on their own. That's what we're offering here. We want you to become a championship level trader on your own by following Chuck and his 35 years of experience. What I want you to do is click on the link below to learn more about Chuck's triple threat and see why so many traders want in on it. You can make money in an up market, down market, sideways market. He's had a real-time accuracy of like 96.5%, 3 strategies. You've got to get in on Chuck's triple threat. Follow the link below. We've got a getting started session starting June 1st, and that's when the challenge starts. And I want you in on it before that. Most importantly, have a great day. Bye, guys.